and welcome to a brand new episode of Smart Money. Now, the markets are close to record highs and foreign inflows into India this year so far has been the highest since way back in 2020, with almost $13 billion coming into the Indian markets from FPIs. But with the markets at all-time highs, there are also a few red flags and perhaps mistakes that you should avoid. Today, we talk about those mistakes that you should avoid in this market. So we always tell you what to buy, but now perhaps we'll tell you what not to do in this market. Our expert today is Vishal Kapoor, the CEO of Bandhan AMC. Vishal, thank you so much for joining us on the show. This is an interesting time, right? Because generally when the markets are at all-time highs, investors have that FOMO feeling, so to speak. But before we get into the mistakes that you should avoid, how are you feeling about the markets now?
We're actually quite optimistic. I think, yes, people are talking about all-time highs, etc., but we'd encourage investors to look at valuations more than just the index level. And, valuations, I think, from different perspectives do look reasonable in that sense, and therefore, we wouldn't be too worried, especially if you're a long-term investor.
Okay, don't be worried if you're a long-term investor, folks. But let's move on. There are a couple of mistakes that we have identified that you can avoid in your investing journey. One of them is staying on the field, but with no goal post. Explain that to us.
So, Sonia, one of the things that, and this is just a caveat that, these are just observations from people, speaking to people, looking at data. So these are not definitive sort of do's and don'ts. These are merely what we feel and see, and therefore just want to caveat. And one of the things is, just using a soccer or football analogy, it's good to see a lot of people on the field, so many investors coming into the market. But what we sense is sometimes we're just running around without really having a goal post. And the reason we say that is, for example, when we look at people coming to our website as an instance, there's 3 times the amount of time spent looking at performance of our products rather than looking at goals and all the wonderful tools that a website typically offers you to sort of look at what do you really want to do. Similarly, when we look at SIP data in the industry, I think every MFD, every advisor I speak to will tell me that, look, based on your goal, you should have an allocation, and maybe an aggressive allocation is 70% equity, 30% debt. But yet, when you look at the SIP data for our industry, you will find that almost 95% is just equity.
Okay.
So how is it that, with 95% of equity, you could be following your goal? Now, it's a very simple hack. If your allocation is 70-30, let's say equity to debt, why wouldn't you have your SIP in exactly the same proportion? And that's just telling you that, we just have too many people coming into the market to make returns or, make quick money, get rich, but
so
not
when you
really
talk about a goal post, right, you say that an investor should have a goal post. What should your goal post be? Should it be your financial goal in the sense of, say, I'm saving up money for my children's education or for my retirement, or are there any other goals that you're talking about?
No, absolutely. So we would recommend that, you have your specific goals, and these are obvious ones: retirement, education, even buying an asset, a holiday, things like that. But moving towards each of those goals is a far better strategy than just trying to make money, is the point.
Okay, got that. So don't just try to chase an amount per se. Have a financial goal, stick to that and work with that, is what you're saying. Got it. Let's go to investment mistake number 2, and this is something that most of us are guilty of, right? Following the herd. Now, what do you mean? Is it going with the flow in terms of trending stocks, buying them and getting stuck at higher levels? And what should people not do in such a case?
So what we are seeing from, again, some of the data that you look at, firstly, when we look at mutual fund buying behavior, right? It's worrisome to see that just about 50% odd of mutual fund schemes stay beyond 2 years. So at one level, you come in to buy a pooled investment vehicle for the long term, but yet the behavior seems to tell you that, within 2 years, you're somehow disgruntled with that fund and you flip over to something else, right? So that's one thing that worries us. The second is, when you look at data for any wave or any period in the market, you will see an emergence of one sector or one type of scheme that seems to be suddenly favored by all. Last year it was sectoral and thematic funds. This year it seems to be mid-cap, then moving to small cap. And you wonder that, if people really had a goal, why would you keep shifting in such a large amount the type of scheme that you want to buy? Which keeps telling us that, look, what we seem to be doing as investors is just going with the trend rather than going back to saying, look, what is my objective? And shouldn't I be staying longer on that objective by holding on funds for a much longer period of time?
So what do you do at a time like this? Because, you know, sometimes these trends work for a long period of time. So, for example, defense stocks, right? They are trending, so to speak, but that trend has been going on for like 1.5 years now.
Right.
Do you stay away entirely from this, saying, you know what, it's okay, I'll stick with the safer stocks, or do you pick up some of these trending sectors?
So nothing wrong in looking at trending sectors, trending themes, etc. But a lot of seasoned investors will apply a core and satellite approach, where you say that, look, a core part of your portfolio is the long, stable, steady, which is largely where you'll stick to the the flexi cap, multi cap, large cap oriented type of stocks or funds. And then you have themes that can sit on top, which are slightly more an overweight position or a riskier position. Now, one should worry when you're putting your entire portfolio of risk at risk, chasing a theme. So that's something that we think one should try and avoid.
Okay, try and avoid chasing a theme. Got that. Investment mistake number 3, aborting your investments too early. Now, by too early, do you also mean that, selling out of fear? Because I remember a lot of people in 2008, not just in 2008, even in 2020, sold when there was this massive pandemic or when there was a recession. One tends to get a bit scared when things like this happen. Is that what you talk about, or is there something else, a bigger mistake that people make?
No, so that's largely it, which is that I think when we look at market data and juxtapose that with flow data, which is how much of flow or buying or net purchases are happening, one sees a trend where you say that when market returns tend to be flattish or negative over the recent past, flows come down or may go into negative even. And we've seen this over periods of time that there's a lag between markets stabilizing or correcting, and then after a few months you see flows coming off. And it seems to suggest that a lot of people look at previous 1 year or whatever their review period is, and if it turns negative, they redeem. And which to us is a very large mistake, because study after study after study is telling us that, as an example, we did a study to look at SIP behavior. So should you just have continued your SIP, what would have happened, right? So if the last 1 year SIP return for you was very positive, let's say 20% and above, versus your last 1 year SIP return being negative, guess what? Over the next 5 years, the best performing SIP would have been where your last 1 year was negative, which is in a sense obvious to market players because it's mean reversion. But it's something that most investors miss out, because at 1 year negative returns, what you see is a lot of people redeeming and saying, oh, actually, my fund is not returning me enough, and this is not a good fund, etc., etc. When actually the probability is very heavily stacked in your favor of making very good returns over the next 5 years. So you're missing out on that upside because you're just being too short-sighted.
Okay, well, so a lot of mistakes we've spoken about, right? Let's move on to investing mistake number 4, which is moving your goalposts. Now, is this more with regards to timing the market? And, what do you mean when you say don't move your goalposts?
Okay. So let's assume I came into a portfolio of funds. And, when I came in, my expected return was, let's say, 15%. Just an example. I would be happy to get 15% returns from my portfolio, and I've bought a bunch of funds, let's say 5 or 6 funds. After a year, it may well be possible, after 3 years in this case, when we've done the study, that you were actually very close to meeting your portfolio returns of 14-15%. But then you see the individual funds, and then you see something at 25% and something at maybe 5%, because there's a range of returns across the funds that you've got. And then you make the fatal mistake of saying, oh, actually, why should I stay invested in this underperforming fund at 5%? And I should move all my money into this outperforming fund at 25%, because that's the best fund.
Okay.
And then, 2 years later, guess what?
If a fund is underperforming, there could be a reason for that as well, right? Maybe the fund manager has left, the other new fund managers come through, doesn't have the same kind of stock picking skills. So what do you do if your fund is underperforming in such a situation?
So definitely, if those were to be the answers, which is that, oh, there's something really wrong, please go ahead and make the choice. No one's restricting you. But often what happens is that, this fund took a series of steps or calls which have not worked in the past, which means that the probability is pretty high that it will work quite well in the future, which is what we keep seeing after every cycle. In most of these studies, you'll see that the best performing funds often don't repeat themselves over longer periods of time. There's a certain cyclicality in the market. So in this study, for example, the bottom performing fund actually turned out to be the top performing in the next period, and then somewhere the next set came in the third period, etc. So the point is that, look, one should have been reasonably happy with the average return your portfolio is making, because you were meeting your goalpost. But suddenly you shifted. 14% was fine. Why were you so, almost like, why were you reacting to the fact that the 14% will be an average of something which is 25 and something which is 5, and then make the mistake? Had you just stuck through, you would have made reasonable returns. But because you reacted or overreacted, you end up making these mistakes, which is really avoidable.
Okay, so patience largely.
Patience, and don't, your goalpost was 14, you were doing that. Why were you getting tempted with 25? You shouldn't have.
Yeah, okay, got that. That's some very sane advice, actually. Let's do one thing. Let's take a quick commercial break on that note. When we come back, we will continue to talk about all the mistakes that you should avoid in your investment journey. Stay tuned. Welcome back, folks. You're still watching Smart Money on CNBC-TV18. We're speaking with Vishal Kapoor, who's the CEO of Bandhan AMC, and we're talking about all the investing mistakes that you should avoid. Now, before the break, Vishal was telling us how shifting of your goalposts is something that you should definitely avoid. If you have a target, then you should stick to it. Vishal, it brings me to the question, whenever anyone picks a mutual fund, mostly people tend to look at past returns to decide which mutual fund they should take. But I understand that that is the biggest mistake that people make. Correct me if I'm wrong, and also tell me, how does one pick a mutual fund then?
Right. So, let's look at, any market cycle, right? And you have 10 fund houses and 10 fund managers who've tried their best to sort of outperform in that market cycle. And let's look at 3 of them who really got it right, and they ended up at the top. Now, these 3 funds or fund houses got this cycle right, and therefore they ended up in the top. Often the mistake we make is we choose all 3 of them. We think we are diversifying by buying 3, but actually we are buying the exact same style or exact same reason that got us to the top, right? Now, does that give us any comfort that they will beat the market again in the next one? Yes, maybe they're great managers, they may do it, but there's an equal probability someone else who did not perform may actually bounce back up. And that we keep seeing study after study that, yes, there's a level of consistency, but the outliers often change quite rapidly. So one way to do it is to actually diversify, which is one of the reasons you are buying multiple funds. Just don't add new fund schemes to your portfolio and think you've diversified. Diversification means you're adding different styles to your equity allocation. And therefore, if you have to choose 3 funds, choose 3 different styles, 3 different ways of managing money, so that given different cycles in the future, you have a better chance that in aggregate you will be able to do well, rather than just chase the same style 3 times over across the same 3 funds. Okay,
got it. Also, you talk about poor scorekeeping as the 5th mistake. Tell us a little bit about that. What do you mean by scorekeeping, and what should people do then?
Right. So a common error we find is that people look at, or investors look at, point-to-point returns to decide how their funds have performed. Right. So as an example, I may look at a fund and then find that, actually the fund has returned 5 or 6%, and I'm not happy with that return, right? I miss the fact that the same fund, I may have invested in that fund through an SIP, and my returns are actually closer to 9%, which is okay, right? Now, why does that happen? Because my SIP return is a monthly investment. It is taking care of, the reason, one of the benefits of SIP is rupee cost averaging, and that rupee cost averaging has given me that extra 4% of what I would call process alpha. The alpha is just because you were in that fund, and because you were averaging every month, your return was 9%. Now, the decision point is, had I known it was 9%, I would have been very happy. But because I thought it was 5%, because I was looking at a fact sheet, or I was looking at a table, I was looking at some other analysis which said, 5%, I'm not happy, I make the mistake of switching it. So the point is that if the scoreboard is wrong, you're looking at the wrong scoreboard, you end up making mistakes like this. And therefore, one way out of that is look at rolling returns. So if you are investing regularly through an SIP, a rolling return is a far better metric to see what your returns are. It's not an exact metric, but it's better than looking at point-to-point return, which has huge biases because of the measurement time period that you may be subject to.
Okay, all right. The 6th mistake is underestimating the power of compounding. And, Albert Einstein said that the compounding is the 8th wonder of the world, right? He said it for a reason. I mean, we all know how it works, but a lot of people are still unfamiliar with it. So you want to take us through that?
Yeah. So again, one of the data that I mentioned earlier, which is that holding periods just seem to be too short for most of us, right? And I think repeatedly we underestimate how quickly compounding really adds value, to our lives. So in a recent, fund, or if we look at an index, often we miss out what this adds up to. So for example, recently I was talking to some investors and I told that, this index returned, let's say 14% over a long period of 18 years in this case. And would you be happy? And they said, yeah, maybe it's okay. And when you tell them, actually, your 1 lakh would have become 11 lakhs, would you be happy? Of course you're delighted. It's the same result. It's just that you don't realize that 14.5% compounding over 18 years would have meant that your money became 11 times or 10.5 times, right? So the absolute is what we understand. The percentage and the compounding over a long period of time, we just intuitively don't get. And therefore, we don't stay put for long enough. And that, to me, is fundamentally one of the biggest mistakes when we are investing through equities.
Oh, absolutely. And there's that old maxim, right, which says that time spent in the market is more important than timing the market. So I guess that's very important. All right, let's go to the last mistake, failure to diversify within an asset class. What do you mean by that? You were mentioning earlier, right, as to how don't put all your eggs in one basket. But at a time like this, where it's very hard for people perhaps to, look at individual stocks, there's so much volatility, don't you think it's best to just sit put with ETFs or with index funds, large, mid and small cap? Don't you think that will be the best way to approach the market?
You could, but I think as the recent past has shown us, there is some significant alpha that can be generated by active managers. And we are seeing that, and you see that in waves. There's a wave when it's difficult to beat the market because one part of the market did very well. But then there are other waves when you can generate very, very significant alpha. One of our funds, for example, over 3 years compounded is delivered, more than 15% alpha. So, there's a significant amount of outperformance. But coming back to the point, again, it goes back to what we mentioned earlier, which is that often I see investors making the mistake of saying, okay, let me pick the 3 best performing funds, right? And, Google search, best performing funds, drop down, and then saying, okay, top 3. Now, as I think most market participants will understand that the top 3 at any given point in time will have very similar characteristics. Often those are sectoral funds, as an example. So there's a certain market phase where past performance of sectoral funds have done well. So you end up buying these 3 sectoral funds. You think you're diversifying, but you're not. You're actually a very, very concentrated equity portfolio. So the point is that when you're buying, just adding more funds is not leading to diversification. You have to look at within that asset class, how are you diversifying? So is there enough large cap? Is there enough mid and small caps? Are there any sectoral plays? A core satellite approach that we spoke about often works as a very reasonable way to sort of do that, which is have some part of your portfolio which is really buy and hold for a very long period of time. Of course, review it. If some fund manager is consistently not performing, you can make a change. Maybe have some sectoral positions or some alpha generating positions, which are themes that you like, that you're convinced about, which is sitting on top. But more and often than not, we find that people are just buying top performing funds based on a listed and changing it too often. So you're really not giving any theme a reasonable time for it to perform.
Okay, all right. Before we wind down, Vishal, since you've spent so much time in the market and there are a lot of people, as we've been seeing, demat accounts are at record highs, a lot of new young investors entering the market. What would be your biggest advice to a young investor between the age of, say, 20, 25 or 30 trying to build their portfolio?
Okay. I would say, since we were using the sport or the football analogy, I would highly recommend that, find yourself a coach. It doesn't have to be, an advisor MFD, although I would highly recommend that. But, often because it's your savings, your money, you can get very closely involved and we can read up and try and do things. But the behavior, at least an aggregate, seems to at least imply that a lot of misbuying may happen. You buy something with the wrong notion in mind because you're also learning, right? And therefore, having someone slightly, distant in a sense, even if it is an expert, it's even better.
Who looks at it with an unbiased perspective.
Exactly, that can really help. So, like in the best of, players needing a coach, you need a coach as well.
Okay, like for everything medical, you need a doctor, right? You can't prescribe your own medicine. I guess you need a financial doctor as well to help you with your, financial health. Thanks a lot, Vishal, for joining us. Really appreciate your thoughts here on Smart Money. Thanks for being with us on the channel.
My pleasure. Thank you for having me.
All right, folks, with that, it is a wrap on this edition. Thanks a lot for watching. Keep writing to us. We love receiving feedback from you. Till then, have a great weekend.